Good morning, everyone. Welcome to the new week. This is the macro snapshot. We are, what are we? Monday, June the 2nd, 2025. Recording this in the morning. Okay, so just quickly, if we go to the news which happened over the weekend. I guess the main things were that we saw at the end of the trading session on Friday, I believe it was Friday afternoon, Trump has decided to put extra tariffs on steel and aluminium imports into the US. There's also been a lot of rhetoric which has heated up. Trump was accusing the Chinese of not, keeping in accord with the agreements made in the Geneva meeting a few weeks ago. The Chinese have retaliated, at least in a rhetorical sense, with some fairly harsh language. So basically, the rhetoric is heating up between the US and China again. Is this a function of Trump's ego, the sort of the taco trade that he chickens out all the time? Possibly. But the point is that the rhetoric is heating up, as I said, and that the idea that we're going to get a very quick and speedy sort of resolution to the tariff talks between China and the US does seem a little bit distant. So we have tension ramping up there. We also have some tension in Russia-Ukraine. Over the weekend, we saw a pretty massive Ukraine attack using drones on the Russian. A lot of long-term, long-range bombers were destroyed on the ground. So the Russians will be going to be very unhappy about that. They're putatively apparently going to be talking in Istanbul, I think, in the next day or two. We'll see how that goes. But basically, geopolitical tensions are ramping up a little bit. And of course, in the Middle East, we still have the situation in Gaza. So let's just have a quick look and see here. So we see gold here pushing out above, basically held. If you just look from a technical perspective here, this is the spot price. You can see here that we held at the fibs and then it's bounced, and now it's actually breaking back above. The bulls of sort of taking this above the on this most recent impulse. That 61.8 fib retracement at about 33.15. They've broken through. Also broken through this sort of downtrend here, the 20-day moving average held. So all the technicals, all of that technical checklist is holding and bull pushing out. It does have a little bit of resistance here at 33.66 on the spot price, but if it gets through there, you have to say that there's some possibility of retesting those recent highs at about 34.35 and then even up to about 3,500 or so. And again, the geopolitics are helping this apart from anything else. Talking about the geopolitics as well over the weekend in terms of the oil, we had OPEC Plus deciding to increase their output by about 411,000 barrels. And the 411,000 barrels was what they had done over the last couple of meetings. So that actually was taken quite well by the market because there had been some fears and some rumors. You remember Kazakhstan last week was saying that there could be more than that. But anyway, the market's taken that as being sort of not a bad result, really. Of course, global growth is still relatively robust. And plus, you add to that the tensions in Russia and Ukraine. And the possibility that Trump, might want to put more sanctions on Russia, and all that to say that we're seeing quite a strong sort of breakout about up about 4% or $2.50 here on the crude oil, and you see that's pushing high here, nice big green candle. It's got a bit of resistance here at the 50-day EMA. Let's see if it pushes through there. I think the main resistance is going to be a little bit high. You see these recent highs here about 63.80 to $64. But so oil pushing up there. I think the bulls, they're really, in order to break out of this sideways trading pattern in which it's been for the last couple of weeks, they first of all have to clear this 50-day moving average. And then secondly, they will have to clear these recent highs, as I say, about $65. And the other thing which is going to be interesting is just this Fibonacci retracement. So you see this, if we go back to the 2nd of April, which was the tariff day, and you see this most recent impulse, the big kind of a barrier and maybe even target is actually going to be the $66 level, which will be the 100-day moving average. It's going to be the 61.8% fib, and also it's going to be some horizontal resistance here. So $66 is a pretty big level. That's something where the bears might want to sort of start selling again. But in the meantime, that's about what's that? About $2.50 away. So that's a plausible target. So a little bit of geopolitical risk. But let's just have a look and just see, pull back a little bit because it's Monday. I like to look at things, have a little bit of Irish breakfast tea here. Okay, so We've now had, where are we? It's now June the 2nd, so it's now been exactly 2 months since Trump's so-called Liberation Day, where he revealed these sort of fairly heavy tariffs levels. And we all know what happened, that there was negotiations, he took them off, he chickened out, he was angry. So a lot of fluctuations. But the bottom line is that the market, I think, has become relatively complacent. The market is essentially saying that we will probably get a fairly low level of tariffs, although some members of Trump's cabinet out over the weekend saying that tariffs were not going away, that tariffs were very much part of the policy mix. But the market in general, I think, is relatively sort of accommodative and almost complacent, saying that, yeah, there's going to be a couple of tariffs, but there'll be like maybe 2, 3, 4%, and that's not going to make a big deal. And so we've seen, as we know, a big sort of push up in the equities and whatnot. But but let's have a look. But we're now in the window where if there was going to be any kind of slowdown for US sort of economic data, it probably should be showing up now, because we've had a couple of months and we're starting to get, data which is from this sort of post-Liberation Day period. And it was interesting that if you look at, let's say, the 2 year, which I'll bring up if I can find it. Last Thursday, did we start to see some of the cracks? So if you see last Thursday here, don't worry, this is just the roll gap jumping up here on the 2 year. But basically, you can see here that last Thursday and last Friday, the 2 year sort of the ZT futures here pushed up quite a lot. And that was because we had the initial jobless claims and continuing claims, which was a little bit worse than expected. We also had a core PCE, which was getting down towards target, where the core PCE is now, between about 2 and 3%. It's kind of in the middle there. So we're not that far away from the Fed's target. And so the question here is, are we starting to see a little bit of a sign of a small breakdown in the US data? So this week is going to be very, very, very important. Because it's going to be quite a binary outcome. I would say that, if the non-farm payroll, let's just look at some of the data we're getting. We're getting data, and again, I'm talking about hard data. We are getting some surveys, but really what the market, I think, is most interested in is the hard data. But we do start off with the survey this morning. We get ISM manufacturing at 10 o'clock. Also, of course, the employment component of that. Then we get factory orders. We also get the JOLTS number tomorrow, I believe it is. Yeah, we get the JOLTS number, which is very important to understand if that's going to weaken or not. Then we get the ADP number on Wednesday morning, and we get ISM services. We also get the initial jobless claims and whatnot on the Thursday. And then, of course, we have on Friday, we have the non-farm payroll. So a lot of data, especially about the employment situation. And I would say that we're in a sort of basically in a bit of a binary situation here. So let's just have a look and see. If you look at something like the butterflies, you look at the 2s, 5s, and 30s. If you look at the different bond yields, we'll start looking at some charts now. You can see that the 2s and the 30s have not done that well, and the money's been in the 5s. But really what's going to happen here, let's just start looking and seeing what's going to happen, because if we start getting some weak data, the front end of the curve is going to love that. And the idea that the Fed will only do 2 cuts this year will probably have to change. If we actually just look, sorry, I just want to skip back to the Bloomberg terminal here. If we go and just look and see what's priced in, you can see at the moment just look at the path here, the market is basically saying nothing for this June meeting. It's saying there's only a 25% chance of something in July, not even 1 cut priced in for September, and then the first cuts is coming toward in autumn. So we have like sort of October, and then by December we now have 2 cuts. So it's been hovering around about 2 cuts by the end of the year, but the market is basically saying that for the next 2, 3, 4 months almost, like not much is going to happen, or maybe some cuts at the end of the year. But the point I'm trying to make is that if the data starts to weaken, and that could happen as soon as this week, the real data, like not just the surveys. If the data starts to weaken, we could have these sort of pricing for the Fed being repriced a lot more dovishly. And that will, first of all, really sort of affect the front end of the curve. So let's just start looking at some of the curves here. And I want to just start by looking at, let's say, the 2s to 5s. So at the moment, as you can see, that's actually kind of sort of flattened a little bit at the moment. But I think what will happen is that if we get sort of soft data, that's going to be reflected in very dovish repricing. So we'll probably go pretty quickly up to 3 or maybe even 4 cuts being priced in. And it could be that if we get soft data, we might even have the specter of a 50 basis point cut. But if we do get that, we could get the steepening up to maybe even up to plus 20 basis points, or even 25, 26 basis points, something like that. We could get a bull steepener here. So that's definitely something to be looking out for. So what's happening at the moment, as I said, if you look at the butterfly, is that sort of investors have put a lot of their money in the 5-year, which is getting a little bit of duration and a little bit of a yield pickup. They're still a bit nervous about, well, I don't want to say nervous. They're nervous about the front end of the curve in the sense that there's not, the hard data has not supported a dovish Fed. And in terms of the 30-year, that's actually hasn't been. Let's just see if we actually have the butterfly here somewhere. We can maybe have a look. Yeah, I think this one here. Okay, so this is the twos, fives, tens. So you can see here, you can see here just how strong here the fives are here going up. And I just wonder if I have yeah, so this is the 30 here. So you can see here, we just see just how strong this is. You see here, the 5-year is outperforming here compared to the twos and the fives. But just getting back to the basic yield curves here. So that's the situation there. Now, if we look at actually the 2-year yield, it looks as though, something around about 407, 408, 409 seems to be the upside. That's going to be capped here by the moving averages. But basically about something about 405 or 406 does seem to be the upside in terms of the yields. And that's just because the market doesn't really want to get a yield which is getting, too close to the Fed funds rate, which is now at 4.33%. Because if it gets too close to that, it's essentially the market saying that, the economy will be fine for the next year or two and the Fed will not need or will not want to cut it all, which seems a bit unrealistic. So at the moment, we just seem to be trading, in this sort of range here of about, let's say, about 375 up to just over about 4% or so. And again, it's going to be binary. If we start to get some softer data this week in terms of the employment market, I do believe that this. If we get weak data, it can definitely go down to, somewhere down here around about 3.7, 3.65, or even further down to 3.55, which is not that far away. And that would just be basically the 2-year yield. Reflecting the fact that the Fed is a little bit behind the curve. And remember that Powell has said that they are waiting for data. They're being very reactive. So the point is that, yes, they're being patient and not doing anything in terms of cutting. But if the data starts to fall off, they will have to move quite fast. And that means that they might have to be quite aggressive to get, in front of the curve again. So the point is that the 2-year yield here could fall, 25 to 35, 40 basis points relatively quickly. The same thing if you look at the yield curve here, the 2s30s, we just looked at the 2s5s, and again, that could bull steepen. But if we look at the 2s30s, that also could bull steepen. So the front end yields coming down a lot more aggressively. And that could, even head up, certainly up to 120. But if you go back in time, it could get up, break that and go back to, let's say, something like the 140s or, getting up here, something like that, 130 or even up into the 140s also if we have the softer data. And keep in mind, guys, the other thing as well is that in terms of the 2s30 spread, is that if we do have weak data, that will imply that the deficit needs to be increased a bit because there has to be more unemployment insurance and all the social benefit programs will have to be paid for. So there's going to be more issuance on the long end. So those long end yields should go up. So the point is that if we do get soft end data, we're going to have dovish Fed pulling down the front end yields and the possibility, the specter of longer, of high, sort of social benefits pushing up issuance, which will push up long end yields, which will sort of steepen the curve bullishly as well. That's coming to interesting. Of course, this is all dependent on the fact that if we have soft data, if the data remains robust or even strengthens, of course, we could get the opposite of what I've been saying. So we could get sort of bear flattening. So we're going to see the front end yields back up again. And instead of having 2 Fed cuts, who knows, that might go down to, I don't think it's going to go less than 1, but let's say down to 1.5 or something like that. So just quickly again, looking at the outright yields, as I say, the 2-year yield here could be capped out at about 405, 406%. If we look at the 5-year yield, I think that could get up maybe to just about this level here, a little bit higher, maybe 418, 420, something like that. The 10-year yield, they could go up. So let's say about 4 point, it's been up to almost 4.6 or 4.8, 4.9, 4.6. And then if we look at the 30, again, I don't see it going really a lot higher, just in the short term at least. It for sure could push above 5%, but maybe something up about 507, 508, 509. And that's just because the real yield pickup is actually not too bad at the moment. Keep in mind that if you're buying a 10-year real yield, you're getting about 2.05%. If you're doing it on the 30-year, you're getting a real yield pickup of about 2.65, 2.7%. So the point is that for real money investors, the real yield, sort of pickup is real, and it's quite a sort of attractive. So I think at the 30-year and the 10-year, for sure they can go up, but I think a lot more of the movement is going to be at the front end. If we have a quick look over in Germany, we can see, just looking at the German 2-year yields here, we know that we have the ECB this Thursday morning, and the market is signaling, no surprises, it's priced in that they will probably cut. But at that point, we might have a little bit of a pause, and it's going to be interesting to see the communication from Lagarde and company, whether they say, okay, we've cut quite a lot, maybe we'll just sort of pause a little bit here. They probably won't be as explicit as that, but just in their communication, if it says something to the effect that, they're going to monitor what's going on, and that's more or less priced in. So I think just here for the 2-year yield, we'll probably just trade around about this, what's about 1.68, 1.7 up to around about 190. So probably just within about a 15 to 20 basis point range, which we're right in the middle of here at the moment, because I can't see this yield collapsing too much more unless the European economy collapses. But I just think, as the ECB has been a little bit more aggressive in terms of the cutting than the Fed, that's probably just where we need to be trading at the moment. And again, keep in mind that what could happen if the ECB sort of indicates that they're getting towards the lower range of their terminal rate, so they're not going to cut too much more in the short term. It's interesting to see, what's going to happen. Could there be even some flows back into the US where the bond yields, where the bonds might sort of have some capital appreciation? Or the other possibility is just that because the German real yields are not very high at the moment, could we get a little bit of money going into, let's say, the Italian BTPs could have a bit of a pickup, or maybe even the French bonds, because remember this is the OATs here, just because they do have a bit of a yield pickup. And again, I just want to repeat, which I've mentioned last week, is that the real yield in Germany. So if you look at the German 10-year, the nominal yield, which I'll bring up in a second. If you look at the German 10-year nominal yield, so it's only about 2.5. And if you look at inflation, the real yield there is only, I think it's about 60, 70 basis points. So a lot less than the US in terms of real return. And I'm just wondering whether the ECB signals that they're done sort of cutting. Could that be, broadly speaking, a bit supportive, for other European bonds, so the French and the Italian bonds, just to get an extra yield pickup, or maybe even some flows back into the US Treasury space, just because the real yield pickup in Germany is not that great at the moment. Interesting. Okay, just looking at some comparisons here. Let's look just quickly at, let's say, the US 2-year versus the German 2-year. So if we get some weak data in the US and the yields in the US 2-year go down, we could actually see this differential coming in. Maybe even down to sort of these levels down here, maybe something like about 195 or so, 190. So that can definitely come back in, especially if the ECB sort of finish cutting, and then eventually that could even fall down a little bit further down to maybe even 180 or so. The other interesting thing is just looking at the SOFR contracts, and what we've seen recently. I'm just going to bring this up. I just need to put this in. So. Oh no, what's the symbol here? I just want to show you just for the SOFR contracts. Actually, we can show that on the Bloomberg. I think I've got it up. Just what's been happening as the market has. Well, actually, I'll bring up the chart. Might be a bit easier. So just bear with me in a second. So short-term interest rates. Yeah. So what I've got here is this is just the yield between the December 25 SOFR contract versus the December 26 SOFR contract. So you can see here on this top sort of table, this top window here, you can see on the white one is the yield for the December 2025, and the orange contract is December 2026. And what you can see is that, of course, they move together. They're highly correlated. But I want you to look in the window below, and the spread And you can see the spread, if we go back to, let's say, the end of January, has actually gone up. It's now about 55 basis points. And you can see here in this top window that the yield in the December 25 has remained more or less, well, sort of flattened in the last kind of couple of weeks. Whereas for December 26, it's gone down a lot more. So what's that saying in simple English? What that's basically saying is that the market is expecting any cuts of the Fed to be pushed further into the future. So let's say in terms of 2026. And that means that that spread has blown out a little bit. And essentially what it's saying is that and the more that the market believes the Fed will be more and more on hold or cutting less this year in 2025, you see here how those yields have remained stable, but those cuts have been pushed out to 2026. And you see here, this orange line has gone down in terms of the yield at 3.325. And that means that that spread between the two has changed significantly. And so, but that's interesting. So the trade there, of course, was as to short Z or December 25, long Z or December 26. The interesting thing this week is that if we get hard data, sorry, soft data on the in terms of the economy, this could actually reverse quite a lot. We could go from 55, we could even get down to, 40, 30, 20. This could go in the opposite direction. And what that would basically mean is that those cuts, which had been pushed out to 2026, might be more front loaded and brought back more towards 2025. So the trade, which I'll be looking at, if we do get some soft data, would be to essentially be trading the fact that the Fed might want to be, the market might want to sort of price in more cuts for 2025. So the trade there would be long Z25, short Z26. So that's something definitely quite interesting to be looking at. Okay, so let's just get back to a couple of charts. We've seen just in the overnight session, quite a lot of weakness in the US dollar. And again, just this idea of maybe the US economy could be weakening, no tariff resolution, sort of more tariffs coming on aluminium and steel and whatnot. So we're seeing here the US dollar weakening quite substantially. This is the dollar index at a pretty key local resistance here of 98.70. It looks like it's just bounced off that in the last few minutes or so. But if it gets down there, you've got to say that your retest down at 98 looks like it's on the cards. If we look, so it's up against all the currencies, US dollar has it basically fallen against the CAD. You can see the Aussie is up against the US dollar. You can see US dollar actually against the Chinese yuan up a little bit. That's the only one. But against the dollar, you see that the Japanese yen has strengthened quite a lot. And especially against the euro, you can see the euro now pushing up quite probably towards the 115 level. And what's going to be interesting also in the USD JPY is whether that just gets below this local resistance at about 142-ish. If it can break through there, you've got to say that down to 140 is probably what's on hold just at the moment. Okay, so let's just again look at the data, because if the data weakens, I think we'll see this US dollar really break down quite a lot. On the other hand, if the data remains robust, I guess we'll maybe just have a bit of more of a sideways action. So just moving on over to commodities, we spoke about oil, how it's breaking out just at the moment, but let's just look at a broader commodity fund. I like to look at the GSG. There's quite a few of them. GSG. Just bring that up. And again, what you can see here is that's over the last 3, 4, 5 days has actually come down a little bit. If we just sort of zoom out a little bit, you can see that again, we're still in the middle of this sort of trade range. So one thing I would say as well is that in terms of input prices to sort of industrial processes and the industrial sector, we're not seeing any sort of broad move up in commodity prices, which in terms of the Fed would give them, I would imagine, some kind of comfort that in inflation, at least coming from commodity price input into industrial processes, is not a huge problem. Remember, if commodities remain low, a lot of industrial inputs, remain relatively stable. Like it's very different if commodity prices were ripping higher above this trade range, but they're still in the middle of the trade range. So you've got to say, where is inflation coming from? Maybe sort of tariff based, maybe from the cost of services remaining relatively sticky, especially in developed markets. But just in terms of the commodity input here, In terms of trades, not a lot to do. It's just in the middle of the range. And in terms of the Fed, that, as I say, is not indicating any sort of upward sort of inflation pressure, at least as caused by commodity inputs. What I would say is that if this gets down to a level of, I think it's about 1950, 1970, something like that, around about here, 1975, that would be quite an interesting buy in terms of the commodities. Gold, as we just saw, I won't go back to gold, but we saw the gold pushing a little bit higher. So let's just have a look here at volatility first off. We can see that volatility has been flattening out quite a lot. Again, it's not at its sort of very lowest points, 12, 13, 14. There's still a little bit of volatility. We've still got a handle of around about, 18, 19, 20 kind of zone. So volatility is still, obviously it's not in its very elevated, 30s and 30 plus, but it's still at, indicating there's some tension or nerves sort of in the market. Right. So the other thing I just want to look at here is the equities. We see overnight equities just coming off a little bit, but not really collapsing, probably waiting for real data. And let's have a look. If we do get the real data, though, I think, this has got to be a sell-off for the equities. We could get down to, something like about 57, 60-ish, something like that. Of course, you see down here, after that, we could even get a gap fill. You see there's a couple of gaps here. We could even get all the way back down there to, 56, 56, this level down here, about 57-ish, something like that. So keep in mind we have these gaps, and definitely equities could push down. But if we get back down there, it would fill the gap. We also then have the 100-day, the 200-day moving average and the 50-day moving average as support. But definitely equities could push down there on the SPX. This is on the cash index. Naturally, if we get trade resolutions and we have strong data, there's no reason at all why the ES can't push higher. Although it does seem that the Nasdaq is possibly the stronger one. If you look at something like QQQs versus SPY, which we can have a look at here quickly, QQQ divided by SPY. Let's just have a look at that. You can see that that's been pretty strong. The big tech stocks until the last day or two have been outperforming, but now finding a little bit of resistance. So it does seem to me that if there were to be any sort of slowdown in the domestic US economy, probably in terms of outperformance, it would be the sort of more globally diversified, those huge kind of tech companies. Just interesting as well, just looking at what could do well in any kind of slowdown on a relative basis. If you look at something like the industrial sector, you see here that that's actually at highs. And so I think really the idea here is to see, where is the Trump administration putting its money? It wants to bring heavy industry back to the US or manufacturing, and it is trying to support some of that stuff. And so you can see here XLI is doing quite well at the highs. If you look at the defense sector, you can look at something like ITA, which just continues to be breaking out to all new time highs. So look at this Eurospace and Defense, the ITA. It's difficult to buy it up here, but on a relative basis, if you do something like, let's say, SPY divided by ITA, just kind of interesting to look at some of these relationships. You can see here that the SPY has underperformed. And the question is to say, well, could it, does it have more to go? And the idea is that, yeah, it could, because yes, SPY has underperformed ITA by a lot. And there is some, sort of low down here at about 3.28. But just on this relative basis, that could go to a lot more. So the point I'm trying to make here is that it's, in my humble opinion, the idea here is to, if there were to be a slowdown, is to say, well, which sectors are actively being supported by the Trump administration, and like defense is one, the industrial sector is another. And that would be something to be looking out for. Okay, guys, so I've already spoken too long. Let's keep an eye on any sort of Trump headlines today. Also going to be quite curious to see if there's some kind of Russian reaction to this fairly significant drone thing. Personally, I'm going to be looking at the front end of the curve. And of course, we've got to start looking at the data, both the soft data in terms of the ISMs, which we get at 10 o'clock. And then, of course, as we start to get through towards the latter part of the week, some of that hard data. Okay, I'll leave it there. Have a great week. Let's keep the conversation going, and thank you.